Hello and welcome to another episode of the Accredited Investors Only podcast presented by Accredited Life. Thank you so much for joining me again today. We have an amazing show lined up with a really amazing guest, and I want to get right into that. But as always, I like to ask, are you living your accredited life? And I like to talk about what that means and what it means to me and what it could potentially mean for you. If you can't tell by looking at me, I'm somebody that loves to cook. In my free time when I'm not doing, real estate and reading real estate and articles and business and all that kind of stuff, I like to kind of unwind with cooking and with, watching cooking videos and things like that and trying new things. And there's a few chefs that I really like to follow for different reasons and for recipes and things like that. And one of them is Marco Pierre White, best known for getting a couple Michelin stars when he was very, very young. He's also known for being Gordon Ramsay's mentor and who he started with. But if you ever watch Marco, man, he has such an attitude about him and such a way that he shows up to the world and does what he does. And I think it's really kind of infectious when you see somebody like that. He's extremely passionate. He has very intense. And he has a lot of, as he's gotten older, it just the wisdom is oozing out of him. And he's just somebody that I absolutely love to watch. And it's just, I think, in a lot of ways, aspire to be, in my business. I think there's always things that you see other people do in their life and the way that they operate themselves, no matter what business that they're in, that you can take with you. And he's somebody where when I watch him and see what he does and how much intention he has in what he does and how he tries to simplify things and just the way that he shows up in the world is just something that I aspire to be in my real estate investing and development career. And one thing that he says a lot is that perfection is a lot of little things done well. And I love that. I mean, I'm somebody that I like to be a perfectionist. I think a lot of times perfection and the idea of things being perfect, people are, it's like nothing can be perfect, or, it's not something to be, to like kind of to want or to search for or something like that you're never going to get it or that kind of thing. And I agree in a lot of ways, I mean? I think it can be, I think there can be a trap to thinking that way, especially in business, and it can lead to, maybe never getting things done. And, perfection, I think, happens over time. And one thing he always says, too, is about, we live in a world of refinement and not creation. So we're always, just refining and getting better, getting simpler, getting more true and real and all that kind of stuff. And I definitely agree with that in a lot of ways. But to go back to the perfection thought, I love thinking of it as a bunch of little things done very well together, because I think that makes perfection more something that's more graspable, something that's more achievable. And if you look at whatever it is you're doing and you chunk it up into these, little pieces, that whatever the goal may be, if it's a property that you're investing in, or if it could be anything at all. If you break up kind of all the pieces of what it is, and you think of how each one can go exactly the way that you want it to be or what you want it to look like and all that kind of stuff, perfection then becomes a little bit more attainable. And I think one of the most important things with living your accredited life and living the life you want to live is it's not going to happen tomorrow necessarily. It's something that you're going to have to work on. It's something that's going to have to be refined. It's something that, as you live and have experiences and get older, it's going to change. So it's always going to be evolving. And I think that's why it's so important to take a holistic look to your to wealth and health and your just how you show up to the world and all that kind of stuff, because the holistic look, I think, is a way to look at those things in those smaller pieces that all lead to what it is that your life is, and your accredited life, as I like to call it. So, like, what are all these pieces that make up who you are, and what you're doing and why you're doing it and all that kind of stuff. So today, I think it's important to reflect on, just compounding, these little things over and over again, day after day, refining, getting better at them, because it's those little things that are going to compound and come together to lead and bring you into that accredited life and living that. So enough of me rattling on. We have an amazing guest today with a really amazing story, and somebody who has had an amazing career that's done that in a lot of ways. I mean, she's been in the business for a long time and has compounded success and learning and all that kind of stuff over the years to be coming up with what she's doing today. So I'm very happy to bring Amy Rubenstein onto the show. She's a multifamily investor. She's the Chief Executive Officer of Clear Invest Group. They raise capital from institutional investors, pension funds, high net worth investors, RIAs, family offices, you name it. And they acquire workforce multifamily housing. So she's had an amazing story and has done some really awesome things, and has compounded success over the years. So without further ado, let's get right into that interview.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Amy, welcome to the show. How are you feeling today?
I'm feeling good. Thanks for having me on. It's good to be here.
Thanks for being here. So introduce yourself in your own words to the audience.
Okay, great. I am the CEO of Clear Investment Group. So we are a real estate investment firm, and we specifically buy distressed C-class apartment buildings around the country. We stabilize them and then we sell them. We are based out of Chicago. I am originally from Chicago. Spent some years in California, and came on back here. And now we work nationally.
That's awesome. So, wow. Okay. I love that. I invest personally in a lot of workforce, affordable housing. We do mostly single family, but some small multi, and a lot of it's full renovation, dilapidated, blighted homes, that kind of thing. So when you say distressed C-class apartments, just kind of paint the mental picture for myself and the audience.
Sure. So we buy apartment complexes that are somewhere between 300 and 1,200 units. And they usually have a lot of managerial distress. So usually what you see is high vacancies, high delinquencies, some deferred maintenance, probably some CapEx that needs to be done. And things just aren't functioning well. There's a lack of communication between the tenants and the landlord. Probably the city is a little bit upset about things that have been going on at the property. And that's where we step in and try to make it better.
Yeah, it's probably going to get city attention if it's that large and it's being run poorly, right?
Correct. Exactly.
Gotcha. So, wow. Okay. So let's backtrack a little bit. So how did you get into the space and the real estate world, apartment world, that kind of thing?
Yeah, I kind of fell in by accident, which I think a lot of real estate people do, just because there's a low barrier for entry into real estate. So I fell in by accident, working on very small apartment buildings. About 22 years ago, I syndicated my first small deal. It was 6 studio apartments, no parking. Nobody really wanted it. It was all vacant. Fixed up those 6 units and rented them out, and then sold the building and moved on to the next. And that was in 2000. What was that? In 2002. So a long time ago, and the market was on its way up, and so it wasn't like you had to be. It was a very forgiving time to enter the real estate market. Yeah. So years going up to 2008 were really easy to be a part of. So I got all of my well, not all by mistakes. I make mistakes every day, but I got a good bulk of mistakes out in that forgiving period of time.
Yeah, well, kind of similar to the last few years in some ways, right? Where it's the tide that rose and kind of brought in all ships, right? In a lot of ways. So how's the business changed over the last few years for you and this model specifically?
Yes, the business has been really strange the last few years. I would say 2020 to now has been a lot of changes constantly. No one's exactly sure where the market's going at any point in time. Lots of pivoting as far as lending, as far as, the conditions of tenants. There's just been a lot of changes in the last 4 years. So you really have to be on your toes in these markets. I would say we've had some big ups and some big downs in this period of time. 2020 was obviously a very hard time coming off of 2018, 2019. Market got really, really heated. And then we had this mini crash during COVID where, we all weren't sure if the world was falling apart. Most landlords did pretty well through that. Some didn't. And that's sometimes where we can find some distress right now. And then we got heated again in 2021 and the beginnings of 2022, and interest rates started rising and things were getting overheated again. And then we got this kind of pause in the market in 23 and 24 where there haven't been a lot of transactions going on and prices have come down a little bit, not enough to get people back into the market, but a little bit. And so we are in a place where, it definitely, I would say that this is a buyer's market that we're in right now. And perhaps that will change, but there's a lot that we don't know about what's to come.
Have you noticed sellers becoming a little bit more lenient on price or, cap rates and things like that? Or do you feel like there's still some lag between where the market's at and where their thought process is and their pricing and all?
Yes to both. I do think sellers have started to come down a little bit. Interest rates have come down a little bit, so it's bringing more people back into the market a bit. But I also think we're still not there yet. There's still a disconnect.
Yeah. That's a good way to put it, disconnect. So with, how do you, God, I have so many questions for you. A lot of times I feel like people, I like that type of product, but a lot of times people tend to gravitate towards the A, the B stuff. What brought you into C and what's kept you there over the years?
I think it's the area of the market that is the least risky and the most stable. And I know that sounds to everybody counter what they originally think of as C class.
Sure.
I'll explain a little bit, but first I'll just differentiate between C class and D class. We're not talking about gang infested areas. We're not talking about uninhabitable products. We're talking about it when we finish our product, we are producing safe, habitable housing that people can feel proud to live in.
Yeah.
The phrase we say all the time.
Yeah.
And what is so stable about that particular area is that it focuses on the workforce of America, and that's not going anywhere. We focus on tenants with an annual household income between $35,000 and $85,000 a year. We're in that range. We're not really competing against the housing market. These are renters by necessity as opposed to lifestyle renters. They're not choosing between buying a house this year or going to rent. And these are jobs that aren't going away. This is hospitality, teachers, janitors, truck drivers. These are jobs that are going to always exist in good markets and in bad markets. And when we definitely dabbled in all sorts of asset classes within real estate and specifically within multifamily. And what we find stays strongest through the ups and the downs is this area, because when the market gets really heated and when things are really good for everybody, everyone rises a bit. So that bottom D class can get hurt a bit there. And when things start to fall, that's when people are downgrading what they're what they can afford, and they're coming right back to us. So it's also, especially in times like this, although I will say in 22 years, it's always kind of been like this, but we buy below the cost of replacement. We sell below the cost of replacement. So you're not going to be competing against new construction because new construction can't afford to rent at the rates that we rent.
Sure.
So bring new construction into the market, then they are going to garner higher rents. So we're not competing against that stuff. So we're in a place that has a great need, especially now. People talk all the time about the need for affordable housing. So that's why I think it's the least risky area of real estate to be in.
Yeah, no, Amy, you're speaking my language. If any of the listeners listen to this show, if they listen to me on any other show where I'm talking more about my business and what we invest in, it's exactly the same kind of thing, and more on the single family side than multi. But it's for every reason that you said. You know, what I mean, with just the bread and butter industries. I always say investing in essential housing for essential workers in essential communities. It's not going anywhere. These people need a place to live, like you said. They're probably renting out a necessity more so than anything. So they really do need a place to live. They don't have the option like, oh, okay, I'm going to buy, interest rates came down a little bit. Let me buy instead. That's probably not the case. But probably the biggest misconception that I've run into is the war zones. I mean, I hear the term war zone thrown around at least once or twice a week with investors. And the confusion between Class D to Class C. I mean, there is a difference, like you said, and so these areas and the tenant profile is different. What would you say, like, how's the construction? Like, what does your team look like? You know, the operations team to be managing the property management along with probably a lot more construction than the average, Class A or B value add type of property.
So we're going to have a significant amount of rehab work, but we're not taking like downed units and bringing them back online. Some here and there. But if we have a 400 unit building, I'm not going to buy it if there's 100 units that have been, destroyed by a tornado and are down to the studs and need all new electrical and plumbing. That's not we're really not developers. So more likely, there's very specific items that need to be taken care of. Maybe a roof needs to be replaced. Maybe the parking lot needs to be repaved. Maybe the elevator is down. Things that are very specific like that. And then a general a rehab of units, but not necessarily, we're not taking every unit and making them all look exactly as. We really believe in expanding the lifespan of each asset within the apartments. So that means if the cabinets are still in good condition and they can be saved for another few years, we're going to save them for another few years. If they're not in good condition and they need to be replaced, we're going to replace them and put something else in. But we're really focused on making sure that we can make the most economical living for tenants in a way that is respectable.
That makes sense. Now, are you the property manager typically, or do you work with a third party? And then same with I'm assuming you have somebody on the construction management side that's managing the turnovers and any vacant to stabilize type properties, that kind of thing.
Correct. Yes, we are fully vertically integrated. So management, back office, construction is all under us.
Gotcha. And is it typically urban areas? Is it suburban? Is it a combination? What's that look like?
We're mostly tertiary and secondary cities, but that's not always the case. Today, we're in Shreveport, Louisiana. We're in Columbus, Ohio, Syracuse, New York, Washington, D.C. is a primary. We have a little bit in Chicago. We're in DeKalb, Illinois. So we're kind of a little bit all over.
Yeah. And what's it look like for an investor typically from a hold period and all that kind of stuff?
Yes. So for our investors, we work in a fund structure. So we're currently wrapping up the acquisitions of our current fund. So we have probably one more portfolio that we're buying in the current fund. We're in 4 other submarkets. And then we're just starting on the raise of our next fund. So the fund that we're raising right now is targeted to be a $300 million fund. Our investors come in as limited partners, and they're anywhere from high net worth individuals up to institutional investors. Okay. And the basic structure is we charge a somewhere between 1.5% to 2% asset management fee. And then there's a 8% preferred return to our investors, and then an 80-20 split.
Gotcha.
Generally the structure.
And for a $300 million raise, how many properties would that typically be? So not in units, but how many apartment complexes would it be?
It's somewhere about 15 to 18 portfolios is how we phrase it. A portfolio would be anywhere from 300 to 1,500 units. And so that could be one building, and it could be a few buildings within one submarket. So, for instance, when we bought in Shreveport, Louisiana, we bought 3 complexes. And that's what makes up, and we considered that to be one portfolio.
Okay.
And in DC, we have one building that's 700 units. In Syracuse, we've got 4 buildings that are about 800 units. So it varies, but it's somewhere, if each one of those are a submarket, it's about 15 to 18 submarkets.
Gotcha. Wow. And is the goal to stabilize and sell, or do you want to refi and continue to hold the properties, or what does that look like?
So we function on a 3-year investment period, and then our typical holds are 2 to 4 years.
Okay.
These are out fairly quickly.
Yeah, that's amazing. Wow. So, how for the investor? Explain that to me a little bit. So, when the raise is typically about a year or 6 months, or what does that look like?
We raise for about 12 to 18 months. I'll really kick it off next month, but we start right away. So we'll start the purchasing right away. Okay. Then
does their pref accrue during that time period? Or? Okay.
Pref accrues during the time period. And our target for our investors is to end in the high 20s for an IRR. Okay. Our track record over the last 20 years is over a 37% IRR. Wow. That's about our goal is in the high 20s.
Yeah. Talk to me about the evolution. I'm assuming, like you said, 22 years ago, you bought that 6 studio apartment. How has it evolved over time? I'm assuming you didn't start. I mean, you didn't go from that to starting your first fund, right? I mean, I'm very curious to how that's evolved over time.
Yes. So different markets call for different periods of growth and different ways that we grow. And of course, when you go through a downturn, it sort of kind of makes you take a step back and evaluate whether that was the route you wanted to go again. We were doing smaller individual buildings from 2002, 2003 up to 2008. And we were based out of California. It was all deal by deal and very local there. And then the market just kind of froze up for us. 2009, 2010, everything just stopped in California. Very different from the way that it worked in the rest of the country. So started to look in other cities, specifically Chicago, because it was where I was from. And in Chicago, what we were finding was that there were a lot of foreclosures on apartment buildings that we were not seeing in California. In California, the only foreclosures that we were seeing were on single family homes or up to 4 units, and that was it. And we were buying those like crazy because we had nothing else to do in the market at that time. We were just sitting still. We couldn't buy, we couldn't sell. So we bought and sold about 70 single family homes in about 18 months. It was a crazy time. But that wasn't really what we did. We wanted to get back into apartment buildings. But again, that was a period of time where a downturn comes and you have to just kind of pivot. Sure. What is the market, right? Are we trying to, we have a general plan, but if the market changes, we got to shift that plan. So that's what the plan shifted to during those couple of years, 2009, 2010. Then we started to see larger foreclosures in Chicago, a little bit larger of apartment buildings. And so we started to think maybe we'll start buying in Chicago. And so we started moving some equity over to Chicago and buying a little bit in Chicago. And then an amazing thing happened as we discovered that real estate has cash flow, which was something that California really did not have cash flow.
Yeah, when you said that, I assumed you were in California, but you were investing in other areas or something like that. Wow.
California was crazy. It's such an appreciation market that now we're buying just based off of appreciation. And so there just wasn't any cash flow. So we got to, started investing in Chicago, seeing that that was a different game, and really liked that game quite a bit more. And so continued to buy in Chicago. And then the deals started to get a little bit larger and larger. We were able to, it was a bit of a different model, again, because it was a cash flow model at that point. And we were buying these foreclosures then. So kept buying in Chicago, and the deals got larger. And then we started making smaller regional portfolios, and then started to buy out of state in about maybe 2015, maybe. Started to buy out of state, and then realized that the only way to buy out of state, first of all, is to buy large enough so
Sure.
that makes sense to be located in another location. And then we found very quickly that larger buildings are in some ways much easier than smaller buildings, unit by unit.
Yeah.
If you have, 50, 10-unit buildings, that's a lot more work than one 500-unit building.
Sure.
So we realized that very quickly, and then started only buying larger buildings, and then realized it was very doable to be managing out of state. And in fact, we really liked having that diversity of market. It really helped. It really helped give a balance in the portfolio. When people would ask us, like, oh, should I invest in this deal or that deal? In the beginning, we would present a deal to investors, and they go, oh, well, what do you think about this one? And I would constantly say, I wouldn't bring a deal if I didn't love the deal. I love all the deals. Like, our underwriting looks very similar in every deal. So if I'm not going to hit the numbers I want to hit, I'm not going to bring it to anybody.
Yeah.
So because I invest highly in every one of my own deals. So I love all of my deals. And the investors that were with us that did the best were the investors that invested in every single deal we brought them to.
Sure.
I mean, we'll put out the returns of what we're projecting for a deal. But I'll tell you, I've never had a deal go exactly as planned. In 2 years, no deal has gone exactly as planned. Could be a lot better, could be a little bit worse. But generally speaking, we can't really project beyond, we make a projection, but
It's almost the only thing you can guarantee, right? That it's not going to look exactly like this. Sometimes I get wary when you deal with investors where they're like asking about cash flow 3 years down the line or so. So I should expect this payment. And it's like you can almost expect it will not work out exactly the way this underwriting model makes it seem, right?
For sure. So we would say, look, if you know you're going to invest $1 million over the course of the next year, then space it out from all of our deals and invest a little bit in each of our deals. And that's how you're going to get that diversification of the portfolio.
Yeah.
So after a while, when we saw that, if investors would pick and choose their own, it wouldn't do as well as the ones that had everything. And so then we decided a couple years ago to switch over to a fund model so that we can just deliver that diversification to everybody. And then and what it really allowed for is, well, it allows larger investors to come into a deal where a lot of larger investors won't come into an individual
Wheel-off deal.
They're heavy in that deal then.
Yeah.
The smaller investors, it allows them to be automatically invested in many deals.
Yeah.
So it really works out very well for everybody. And then we're not as, we know then that we have this buying ability to be able to really capitalize on any deals in the market that come up and move on them pretty quickly.
Yeah. You actually, that was going to be my next question, was how did you transition, because I love the fund model about it. And you don't see that often too. It's out there, you see it, but it's not as often as you see these individual syndications. And I definitely think as somebody that manages funds, I think there's a benefit to being diversified across your different portfolios than to just being those one-off deals. How has your team evolved over the years? I got to think you have a pretty well-equipped team, from acquisitions to underwriting to property management, construction management, all that stuff. So how has that evolved? And what do you do nowadays? Like what's your main focus, and how has that evolved along with it and all?
Yes. Well, a few years ago, I realized that if I hire people that are all smarter than me, and that the company's going to run much better. And that hasn't happened. I don't know why I didn't.
I like that.
Before, but people in this company now all do their roles better than I could do their roles, and that is a beautiful thing.
Mm.
And so I get to focus on the things that I'm best at, which is the actual deal making. Really making sure that figuring out the final phase of the acquisition. Is this the deal that we're going to want? And then negotiating through that deal and then coming up with a strategic plan for that particular deal. So that's in my wheelhouse, as well as some of the bigger relationships. So our lenders,
Mm.
I am a major point of contact for our lenders as well as our investors. So I do a lot of fundraising too.
Gotcha. How has the lending changed over the last couple of years? Are you putting more down on properties than you were, or what's that look like?
It has been a really strange few years. I would say that's the biggest change in the market in the last 4 years. Just lending. Banks are lending, they're not lending. They're lending, they're not lending.
Yeah.
And now all of a sudden there's all this private equity out, private funds out there that didn't exist before.
Sure.
And they're lending. At first they came out with crazy rates for their loans, and now maybe they're adjusting a little bit, and they got really scared to lend at all. So banks started really pulling back in a way that I've never seen before. I would say in the last 20 years, we almost always went with very traditional banks.
Income.
We rarely went to private debt funds or any sort of alternative lending. And now more and more we're looking at that because and going those directions because banks are just very skittish right now. And requirements for banks are different than they used to be. Even on existing loans, banks are like watching things very closely in ways that they never did before. As far as debt coverage ratio, constantly checking up on a monthly basis. I get bankers now reaching out for updates on a regular basis.
Wow.
I didn't hear from banks for the first 20 years of my career. Nobody wanted to talk to me unless we were buying something
new property. Yeah.
Chaos letter. And that was only, we pay our mortgage every month and we weren't talking on a regular basis.
Yeah.
Now they will always want to know what's going on and they want to be informed on how the deal's going. And, is something off track? Is the model not turning out the way it was supposed to? And so we look at, so interest rates, I would say, not only are they higher than before, not historically high. Interest rates aren't historically high right now, but they're higher than they were in the last few years, right? Last however many years. And the spreads are increased quite a bit. So that was something, 2 years ago, we were underwriting 250 basis points over SOFR. I haven't seen 250 basis points over SOFR in the last 12 months. So, there were some of the loans we were getting at were even down to like 225 over SOFR. And now really 300 to 400 over SOFR is a little more typical. So that's a change, especially when your interest rates are a bit higher. That, and, I think banks are also more traditional banks are reducing their loan to value. But on the flip side, when you pay a little bit more for debt funds, you can get that leverage like we used to.
Yeah. Interesting. Do you do anything with like Section 8 or HAP contracts or anything like that, or is it typically market rate kind of stuff?
Our buildings are all market rate buildings, but we will take vouchers for some of this, but that's not our business model.
So what it kind of when you look, I'd be curious to like walk through a deal, and like what is it about a market that you kind of like, or because I think that's one of those things, like a lot of markets have brought on so much new supply. And new supply, whether it's Class A or Class B or C, and the data tends to show that new supply in the market affects rental pricing and things like that. So I'm curious to like what do you look for in a market when you get into it? I think people I think a lot of times investors and fund managers get tied up in the macros when I think micro is very important as well. When you actually when you have to go lease the property, right, and all that kind of stuff and stabilize. So what do you look for in a market when you get in? And then I'm curious to take it a little bit further on the deal itself. To what kind of vacancy rate do you want to see? I mean, and then I like what you were saying before, where it's like if a tornado went through one of the buildings or something, that's probably not where you're going to be at. So you're looking for opportunities to, just like increase value through, just minor renovations that will maximize your rent, there. But at the same time, like in dealing with this space, we've realized internally when you push market rent, that's when you start to run into issues. You might lease it, but it's harder to do it consistently over time, and then it's harder. Then for a few months you get it in on time, and then starts to drag. People start paying late and stuff like that. So we've always felt that when you're a little bit below market, you lease quicker, and you tend to get more consistency. People stay longer. So I'm curious if you feel the same on the multifamily side. So just curious to get a little deeper in on a property like a typical type of property that you buy.
Sure. Well, I'll start with the beginning of your questions. I think you're absolutely right that the microeconomics is way more important than macroeconomics, especially in this particular asset class.
Yes. Mm-hmm.
We try not to look at macroeconomics. Of course, we pay attention to it, but we try not to gear anything towards macroeconomics at all.
Yeah.
We have no idea what's going to happen. We don't know what's going to happen with interest rates. We don't know what's going to happen with unemployment. We don't know what's to come in the future. And all of that is so speculative.
Mm-hmm.
We try not to base our deals off of that. So what do we base it off of is the microeconomics. We want to know as much as we can about the submarket itself and the past and the future, because we can't tell the future. So we're going to look at the trends of the past. So we're looking for submarkets that have a large enough population in them. So we have a minimum population size. We're looking for markets that have enough employment in them. We want to make sure that there are multiple sources of employment. We want to make sure that the population has been steady. We don't want to see any decline in employment, decline in population, decline in not rental income, but personal income, and rent rates too. We want to watch what's going on with rents. Are we rising? We look for stable markets, not growth markets.
Yeah.
Stable markets. We want to know that rent has not decreased and that rents have generally kept up with inflation. So that we're just steady. That's all we want to be. And we're looking back over the last 10-year period of time to make sure that we're seeing that.
Okay.
So that gives us an idea of what is the value of the buildings that we're buying. Forget the idea of what the income is today, because that doesn't matter to us what the income is today. That's a number. That's not what we're buying, because we're planning on making it better. So what we're buying is the potential of the asset itself, the potential based on the current existing microeconomics. So we're looking when you say, what kind of vacancy rate do you want to buy? We can buy low vacancy and we can buy high vacancy. I would say probably generally speaking, we land somewhere between 60 and 75% occupancy, with maybe effective occupancy being a half to 2/3 of that.
Okay.
So meaning who's paying their rent.
Yeah.
But we could find a building that is 90% occupied with nobody paying their rent. We could find a building that's 20% occupied. Either way is okay. We could okay. We don't have a qualification on something that has to be one way or another. But there has to be something wrong. Something has to be wrong, because otherwise we are not needed and someone else will come in. Yeah. And if we're not needed, then someone else is going to pay a higher number and we're not part of the game. So I agree with you that we have the same theory that we would like to be in the average rent where everyone is. We don't want to push the market too high. We want to get our occupancy up. We want to get our tenants happy. We want to offer a higher product, a product that is comparable for the higher level of that particular asset class. That's about average. That's our goal.
Yeah, no, that makes a lot of sense. God, how do you kind of from a PR or branding perspective, like you said, that you're coming into a building where there was an issue. I mean, there were problems. Management was distant, or there was kind of maybe a little bit of a slumlord mentality. How do you get people to know that it's different? You're under new management now, and we're going to operate differently, and we care. Like how do you make that shift? Or in some ways, do you have to clean house a little bit? Because it's hard. Is it hard to fight that? Like, what does that look like?
We uh we always choose to over communicate during the due diligence process with our tenants. So we're walking every single unit of the buildings that we're going to buy, and we try to every single tenant that we can possibly speak to.
Wow.
And we're letting them know we're looking to buy the building.
Mhm.
We want to change X, Y, and Z. What are the issues that you're having here? Is there a reason that you're not paying your rent if you're not paying your rent? If we were to fix those problems that you're complaining about and do what we say we're going to do, are you willing to pay your rent? And do you want us? Does it sound like a good idea to you that we come in and make these changes and buy this building?
Mm.
And if we don't have buy-in from the tenants, we're not the right people to come in.
Mm.
But generally speaking, we always have buy-in from tenants because we're doing things, our interests are aligned.
Sure.
We want to stabilize the property. They want the property to be stabilized too.
Yeah.
They don't want to be living in a vacant building.
Yeah.
They want to be living with deferred maintenance. They don't want people who are unresponsive to their needs and requests. So our interests are very aligned as to what we see a successful building looking like. Now, maybe we can't solve every one of we can't give them every request that they have, but we're gonna do a good job of getting towards that image of what the community should look like. The people that don't want that image of a nice community, they're not the right people, generally speaking, for the community, because all we're saying is we want to have a safe property. We want things to be clean. We want some level of community decorum. And, people that are against that are not the people that we're going to want there anyways. And so we generally don't fight with our tenants in that sense. We're aligned.
Mm-hmm. Yeah, that's amazing. I think the alignment is so important with tenants just as much as investors. I think a lot of times people think of alignment with investors, but they forget or they kind of secondary alignment with tenants when that's extremely important. So. What do you see if you had to bring the crystal ball out? Where do you see the future heading? I love what you said about just how you look at the micro, because I think that's so important because with workforce and affordable housing, I think it's somewhat isolated from a lot of the craziness and other for asset classes and all. I mean, on the commercial side, it's a little different because you have commercial loans. They are recasting. I mean, for us on single family side, it's usually 30-year fixed, 30-year AM. So it's a little bit different from an isolation perspective versus the rest of the market. But the supply and the demand metrics, sounds like they're in your favor in all the markets that you're investing in. So I'm curious to hear how you think the market's heading. I mean, where you think it's headed, what you're excited for, what you're worried about, all that kind of stuff.
There's so many different ways this can go. you know, the last year people were talking about interest rates dropping way more than they dropped in the wishful thinking. So we were never underwriting for any drops in interest rate because we don't know. So we weren't underwriting it. So for us, the 75 basis point drop was welcomed because we didn't underwrite for it. I think what we were hearing a few months back was rates will continue to drop throughout 2025. I don't know if that's going anymore. I think we might get people are saying the markets are betting on another drop in interest rates this week. Beyond that, I don't know. I didn't have confidence that interest rates will drop significantly, if at all. And now we're starting to hear people talk about interest rates rising with the new administration. That would that would push, I believe that would push the real estate market to remain a buyer's market. But I think that it might push people into a bit of a tailspin. I think right now already, a lot of the new energy of people coming back into the market with these recent rate reductions is because people are hopeful for what's to come.
Sure.
And it's already affected the market.
Yeah.
And, what is the psychology of it going to be when interest rates start to go up again? I think people are going to get nervous.
Yeah.
But, affordable housing is always in high demand. It is in high demand now for sure. I think it will remain in high demand if tariffs increase inflation, then we're going to see people start to struggle a little bit.
Yeah.
But then again, we have a president coming in, not to talk politics, but we have a president coming in who is a real estate guy.
Sure.
And if he can come up with a way to make real estate a hot market, I think he's going to attempt to do that. Not to say anything more on that. But I think, certainly his interests are aligned with the real estate world.
Sure.
For better or for worse.
Yeah, no, I think you make some great points, and I think nobody could argue that it's going to continue to be a renter's market moving forward for some time. Unfortunately, in a lot of ways, but fortunately in others, depending on what side of the spectrum you're on. And I think for interest rates, I think when there started to be a dip, there were so many sellers on the sidelines, that as rates went down, as rates, the value of their buildings are changing. Yeah. And so when rates are going up, their values are going down. So it's just, there's always that little delay between, you kick yourself in the ass thinking I should have sold this 6 months ago. So you delay and you want to wait, that kind of thing. So it's, I think you have some of that going on, but at the end of the day, it should be interesting, and it sounds. I like what you're saying about just how your underwriting is. You're not basing that in. I feel like sometimes people, in order to make deals work, they have to align the underwriting in a way to that kind. Yeah, exactly. Yeah, and you run into some issues then, right?
Yeah, for sure.
Awesome. Well, I really appreciate your time. I appreciate you being here talking to me. I didn't realize that, how much of alignment there was between our strategies and what we do. So it was really fun to talk to you. And, I really like what you're doing. For investors that want to learn more about your current fund, it sounds like your new fund, how would they find out more about you?
Our website, you can get to us through our website, which is clearinvestgroup.com.
Awesome. Well, Amy, thank you so much for being here, and best of luck to you moving forward. And, hopefully talking to you again sometime in the future.
Wonderful. I look forward to it. Thanks so much for having me.